Welcome to the channel. My name is Jorin. I'm a quality investor. Without taking too much of your time, we're going to dive into Nike. Nike has had a beating. It hasn't been going too good. If we're going to look at the share price appreciation, depreciation of Nike, we can see year to date they're down 24.51%. It's awful. It's awful to see. If you look at a 5-year time period, let's go from the all-time high. We're down 68.5%. So something isn't going right for Nike. It definitely isn't. If you see me looking there, I got a couple of notes that I have. So I'm sure I'm saying the right information. And it's weird to me. It's weird to see Nike being, down almost, what was it again? Like almost 70% from its all-time high. Nike has been pretty much a household name for everyone. If you would ask any random stranger on the street, like, name me some clothing brands, I'm sure in the top 5, someone will say Nike. I'm sure of it. I think you'll hear Nike more than like On or Hoka or Lululemon, for instance. Especially here in Europe, I think Nike is still, and in Asia, Southeast Asia, I think Nike is still a very dominant name in the industry. But it's taken a beating recently, since 2021, it just went downhill. So on 30th of September 2022, we reached a low of $83 per share, rebounded a little bit into the 120s. And then it just went downhill from there. And it's sad to see. I really like Nike as a business, but I do think management played a huge role in the depreciation of the share price and the depreciation, or I don't know how you say it, but the fall in the fundamentals. Sales were declining, or growth. It was just non-existent. And I think mainly management is to blame here. Because they had cut R&D expenses under John Donahoe. They cut R&D expenses, which is the most stupid thing you can do, by the way, to cut R&D, because you're like, yeah, let's just focus on the existing pipeline. That's stupid. You have to keep innovating. Why would a CEO do that? I'm glad Elliot Hill is now the CEO. He actually put a plan into work, where we'll get into later. It's a wonderful plan. But we're going to talk about Nike. So Nike, promising business. A lot of athletes work with it. I have to look at my notes to make sure I say the right athletes. Think a lot like Jordan with the Air Jordan line, Michael Jordan. With Brooks Koepka, they had an Air Zoom Infinite Tour. Gabby Douglas, there's an athleisure line inspired by Serena Williams. And there's a lot more athletes, as you can see here. There's just so many athletes. It's bizarre, and this isn't even like half of it. This is like a couple percent of the athletes. These all have exclusive contracts with Nike, so they get paid by Nike. These athletes are their marketing, and they have to wear Nike. So this will motivate young and vulnerable teenagers who see their favorite athletes wearing Nike to start buying Nike. It's wonderful marketing, well worth the capital you have to put in it, because trust me, like getting Michael Jordan or getting a Tiger Woods to sign a deal, it's not cheap. It's not cheap at all, but it pays off. Well, it used to pay off. Now it doesn't anymore. Okay, let's go for some headwinds. I have a couple of headwinds. I'm going to read them off. I have them bulleted right here. Slowing and declining sales in North America and China. Well, China was a really promising expansion path for Nike. China is an untapped market for Nike. They could have really benefited from the Chinese market, but they completely failed. They just failed. It looks awful. We can even look at a chart on FinChat. There we go. It is, it's sad to see. China is a wonderful market for expansion. It's very consumer driven, so Nike would have just fit in perfectly there. But management just didn't execute there. So let's go over to the financials. By the way, if you want to try FinChat, I use it for everything investing related, for earning releases, for the financials. You can use the link in the description. You get 15% off forever on your subscription. If you don't want to, don't bother. Just don't. Let's go to the segments and KPIs. And let's go to Greater China revenue. So we saw excellent growth from 2013 all the way to 2021. We saw excellent growth. Even in the pandemic, there was still growth in China. That shows how consumer driven the Chinese market is. And you could really bank on the Chinese market. But after 2021, it hasn't gone anywhere. It just started declining. We had a small spike in 2024. The latest 12 months, it's estimated to be down roughly 4%. The last time I checked. So it isn't looking too good. And that's sad to see. It's a promising market. I really hope Nike would take advantage of this, but they just didn't. The same with the North America, like I said. It's a mature market. They've been in North America for a while now, but also North America is starting to show slowdown. Well, this here is a bit of cyclicality. Nike is very cyclical, as many of you know. Then we had the pandemic in 2020. Of course, a drop in sales. But this, in contrast to China, shows how different it is and how strong the Chinese consumers are. It's bizarre. So that's why I'm so surprised they're not executing well in China. After 2020, we've seen increase in sales up until 2023, and there it's just going downhill, and the issues start to rise. And luckily, we have a new CEO, Elliot Hill. What I've read and what I've heard about him, wonderful CEO. So I really do believe in the turnaround that, he's executing right now. We'll talk more about that in a little bit. The next issue, that's inventory. Inventory, that's always been a big issue, or not always, but it recently has become a big issue for Nike. So if we're going to go over to their inventory, as you can see, in 2020, it spiked. COVID. I can understand that your inventory rises during COVID. Logical. Consumers are buying less. You bought so much stuff, it has to go somewhere, so it goes to your inventory. In 2021, you see a small decline because consumerism is picking back up again. But in 2022, 2023, it just skyrocketed by mismanagement of the inventory. And in 2024, we see a steady decline. And in the latest 12 months, I think we're going to see a bigger decline because with the new strategy we'll come to later, they actually addressed the inventory and they've acknowledged the issues there. But what kind of put the nail in the coffin for the inventory really is the days, where is it? Days sales outstanding. No, days, not sales. Days inventory outstanding. This isn't good. 103 of day sales of inventory outstanding. That just isn't good. They used to be at 91 to 96. I think that's a somewhat healthy range for Nike to be in. For the people who don't know, this is basically a working capital management ratio that measures the average number of days that a company holds inventory. So you don't want to see 102 days of holding your inventory before it turns into a sale. So items will be in their inventory for 103 days, almost 104 days before it turns into a sale. And that's just awful. They have such a high inventory. This inventory now needs to be, they need to get rid of this inventory. And how are you going to get rid of inventory? You're going to sell it at a discount. You don't want to sell it at a discount. You don't. It's going to impact your margins. You'll lose somewhat of that premium edge Nike sometimes has. That's that exclusivity / premium. It's not like the LVMH or Hermes type of premium. But still, Nike has somewhat of a premium. And getting rid of things with a discount, it just impacts that premium aspect of the business as well. It hurts your margins because you have to discount it. So instead of $130 for a pair of shoes, you sell it at like $100. That's $30 of margin that you're going to miss. So you'll go from, 46% to like 35 something ish. I'm not the best with calculating in my head, but you get the drill. So that is yeah. yeah, it's not good for Nike that that the inventory is rising so fast. So the next thing is the consumers are shifting to streetwear. We'll address this really quickly. I made a post about this recently. The core audience of Nike is teenagers. We all know it. It's teenagers between the ages of 15, 16 to 21-ish. And Piper Sandler published its biannual Taking Stocks with Teen surveys. The firm surveyed a little over 13,500 teenagers across 47 states to get a pulse of what is driving spending among younger generations. In the latest report, saw teens' preference for Nike slip for the first time in years. Although Nike remained strong in the clothing and footwear survey, other brands made more substantial gains. So if you want to look at the report, you can get it on this site, pipersandler.com/teens. Some quick notes here. Nike maintained its number one spot as favorite brand for all teens in footwear. Nike shed 4 points year over year, going from 61% to 57%, with a sharp drop amongst females, 48% this fall versus 56% last fall. That's a pretty significant drop, in my opinion. And the upper income cohort seeing an 11 point year over year decline. That isn't looking good. And if you compare it with Lululemon, right below it, Lululemon maintained its number 3 rank in apparel for all teens with 5% mindshare, down 1 point year over year. For upper income teens, Lululemon lost 4 points of mindshare year over year. So yeah, it's also not looking too good for Lululemon, but still a little more optimistic in comparison to Nike. And then New Balance moved from number 3, moved to number 3 from number 4 last fall. The upper income teens doubled its mindshare to 8%, while females, Adidas had the biggest increase to 14% this fall from 3% last fall. So New Balance is doing remarkably well. And that's in the case of Nike investors, that's not something you want to see. And the attributing factor to this is, as I mentioned here, Nike is losing market share. Yeah. So here, Adidas, New Balance, On, Hoka gains as Nike loses market share. So this is in the sportswear. So Nike last year had 15.2%. Right now it has 14.1%. It lost 1.1% market share. That's crazy. Adidas went from 8.2% to 8.9%. A solid increase. Puma, they went from 3.4% to 3.3%, a 0.1% decrease. New Balance went from 2.6% to 3%, a 0.4% increase. On went from 0.8% to 1%, a 0.2% increase. And Hoka went from 0.7% to 0.9%, that's a 0.2% increase. You don't want to see this if you're a Nike investor. Not at all. It is, it's ugly to see. Nike has been a household name. Nike has dominated the market, and now competitors are eating away at Nike's cake. And if I was a Nike investor, I wouldn't like seeing this. Of course, this is in a short time span because it's just recently starting. So we really need to see if this is gonna keep going like this. If Nike is gonna keep losing market share. Do I think they're gonna keep losing market share? Maybe. Management really needs to focus on innovating and refreshing their products. I think that it could save Nike from losing more market share. Because if we just look at like the total revenue, so the total sales of the business, Nike, yeah, it isn't looking good. It has, here COVID again, and then you see some moderate increases, 2023 to 2024. Yeah, no, this is barely more sales have been made. And for the next 12 months, I think roughly minus 2% year over year was expected. The last thing I read, a report on Nike. So that isn't looking too good. But then if we go over to Lululemon, for instance, Lululemon they've been going at it with their sales. It's insane. And you could argue that Nike has the law of large numbers working against it. Maybe, maybe not. But one thing it definitely does not have working for it in its favor is its current product line. It is just, They're not updating it. They're not refreshing it. They're not innovating anymore. John Donahoe cut R&D spending because he wanted to focus on the current pipeline. The worst idea CEO has ever made, probably, except for fraud, like Wirecard. But Lululemon is still pushing out new sales. Lululemon is still growing. Also in their segments. Also in China, they're also still growing in China, this shows that it is possible to still execute well in a tough environment and execute well in other countries like Lululemon is doing in China. It's not a huge, there's some change. It's not massive, but still Lululemon is making more sales in China. If we go to On Holdings, a direct competitor of Nike, because they do footwear and apparel as well. Let's look at the shoes and apparel revenue. Still increasing. Also, if we look on a quarterly basis, if FinChat's going to load, it's looking solid. It's looking perfect. Also for their apparel, it's looking good. On is still growing. I don't see any slowdown coming anytime soon. They're gaining market share. They're selling more. It's going really well for the business. So that's definitely something Nike should really be cautious of. And if we go to Decker Outdoor, they own the Hoka brand. And there we go. Total revenues. Also, year over year, still growth in this segment. Quarterly, also modest growth. So this does show that this is a Nike-centered issue. It's not a industry or apparel or footwear issue. It is definitely a Nike issue, and the previous CEO was primarily the blame here. And Elliott Hill did put in a turnaround plan. We'll go over that in a bit. But as you can see, the competitors are doing well. Even during the tariffs, we'll get over that too in a bit. All those struggles, the industry is slowing down, and tariffs are being hit. Consumers, there's a shift in consumers' demand, but everybody's adapting besides Nike, and that's worrying. I don't like seeing that. If I was a Nike investor, and I hate to see it happen to Nike. It's a beautiful company. Besides this, it's a very, very robust company, robust financials. It's perfect. So it sucks that this is happening. And chiming in on what I said previously, the tariffs. Yeah, that's gonna put another nail in Nike's coffin. Because I'll have to take a look at my notes here so I make sure I say the correct thing here. Nike produced approximately 50% of its footwear and 28% of its apparel in Vietnam. Vietnam got hit with 46% tariffs. 46%. That's gonna disrupt Nike's supply chain. It's gonna impact their margins. That's not good. This is awful. This is like the worst case scenario for Nike. So on April 6th, this article came out. Vietnam asked Trump to delay implementation to tariffs while the two sides negotiate. Vietnam has asked the United States to delay the April 9th implementations of the sky-high tariffs announced last week. Vietnamese Communist Party chief Tô Lâm was one of the first world leaders to speak with Trump last week after the US president announced a flurry of tariffs on almost every country that exports to the United States. Vietnam was hit with a 46% tariff rate. On this news, Nike stock jumped again because they were like, yes, the tariffs, they're going away, or there's some negotiation, so they might go away if they're going to be lower. So investors were happy. But then we got this release. Vietnam's tariffs offer rejected by Trump's advisors, not a negotiation. This is the worst case scenario for Nike. It's awful. Vietnam's offer to lower its trade barriers to delay the implementation of US President Donald Trump's reciprocal tariffs have been rejected by the White House advisor. Deputy Prime Minister Bui Thanh Son met with the US ambassador to Vietnam, Mark E. Knopper, on Sunday to reiterate his country's willingness to lower the import tariff rate on the US products to zero in hope of postponing the onset of the new tariffs, according to the government dispatch. However, U.S. Senior Trade Counselor Peter Navarro rejected this possibility later that day, telling Fox News, This is not a negotiation. This is a national emergency based on a trade deficit that's gotten out of control because of cheating. So investors got really happy that the tariffs were going to get negotiated between Vietnam and the US, because the 46% tariff, it's insane. That is absurd. You don't want that, because Nike, with having 50% of its footwear and 28% of its apparel in Vietnam, they're going to face some tariffs on the apparel and footwear right there. It's bizarre. And there's another headwind coming after this as well. So investors got really happy that this tariff was going to get negotiated. And now Peter Navarro is basically saying, no, it's not going to happen. This is not a negotiation. You have a trade deficit with us. And we're going to fix this deficit one way or another. And it's going to be tariffs. This, by the way, is going to destroy, well, not destroy, but it's going to heavily impact Vietnam's economy, and it's going to heavily impact Nike's supply chain. That's for sure. Another country that got tariffed, which Nike uses for production, is China. So China is responsible for 18% of the footwear and 16% of the apparel production for Nike. What happened to China? China got an additional 34% tariff. I think China already had, I think it was like 15% tariff, an existing one, and they got an additional 34% on Liberation Day. Again, that's just bad. And China reciprocated by also implementing tariffs, and now Donald Trump said, China tariff through social. He said, like, if you're not going to remove the tariff, we're going to put 50% on top of this 34% you've just gotten, and we will not negotiate. Negotiation is off the table. No, I can't find his original post. It was funny. It's like a little kid. He's screaming all caps. It's funny to read his True Social sometimes. I recommend it. But here, Trump threatens to add 50% tariffs on China if retaliatory tariffs not dropped. Yeah, this isn't good. China issued retaliatory tariffs.
We're lucky to start
of 34% on top of the already record-setting tariffs, non-monetary tariffs, legal subsidization of companies, and massive long-term manipulations. So there's just a lot of going back and forth here. China already said, and this is pretty threatening to big tech in America as well, they'll abolish the IP protection. So that basically says in China, there's a law, I think around the world, there's all these laws. You cannot manufacture Apple or very similar Apple products as an infringement of their patents. China said, well, we're just going to abolish it. They're threatening with it. So they're just going to say, we're going to abolish it. That means that in China, we're going to produce your iPhone $15 on the cents or 15 cents on the dollar. Yeah, it's not looking good. We're in a full-blown trade war around the world. I'm from the Netherlands, so I belong to the European Union. We got hit with a 20% tariff. I'll leave my political and personal opinion out of this, but let's keep it factual. It is a trade war. We had this in 1836, or I'm not sure the date. We already had some kind of trade war, and it didn't end well. Sky high inflation, recession, companies going bust. It's just not good. So yeah, this drop, this here was management. This here is just uncertainty, all uncertainty, and especially here the last one, where it dropped almost 30%. The tariffs, it's gonna kill Nike. If you cannot properly offset the tariffs on the consumers, it's gonna hurt your pockets. And something that comes with these price increases is that you already have that consumers are shifting away from Nike to other brands. So you have a lot of customers who are doubting. So those are, you could consider them soft leads. So they're not cold, but they're soft leads. They're warm. and now you're going to raise prices, you can push away a lot of those leads that were doubting. So it's gonna do some serious damage, I think. And the fact that the US is saying no, Vietnam, this is not negotiable. Yeah, Nike supply chain, it's gonna endure a lot of stress for a while, because I don't know how long these tariffs are gonna last, how long someone can make them last. But it's going to take some significant strain on Nike's supply chain. And that is just another nail in the coffin you don't want as a potential or already invested in Nike. So that isn't looking too good at all. So I mentioned previously the over-reliance on DTC strategy, declining innovation and product fatigue. We'll go over those right now. I'll have to look at my notes because I want to make sure that I completely cover the new strategy. Elliot Hill brought to life a new strategy called Win Now, and that's going to address a lot of the issues that a lot of investors actually have. So the first one is refocus on sport and performance. So this is mainly going to prioritize serving athletes through a lens of sport and performance, emphasizing Nike's heritage as a brand rooted in athletic excellence. This includes amplifying athlete storytelling and delivering high-performance products tied to major sporting moments like the Olympics and the Super Bowl. The next point in this Win Now plan is product innovation and refreshing the pipeline. This is crucial. This is crucial to Nike. It's good that Elliot Hill, the new CEO, is tackling this head on, because the fact that John Danaher cut R&D spending to focus on the current products, the current pipeline they have, destroyed so much value. It has to be one of the worst decisions ever. And Elliot Hill, he noticed this issue and he faced it head on, which is good. Right here it says, Nike aims to accelerate the introduction of new innovative design while clearing out outdated inventory. This addresses press criticism of stagnant product lines under the former CEO John Danaher, who cut R&D budget and focused on existing demand rather than bold innovation. What CEO is like, yeah, no, we're not going to innovate. No, we're not going to do it. We're just going to stick with what we have right now. Stupid. It's just stupid. So in the latest earning calls, Elliot Hill said the following. At the same time, our team is focused on creating brand distinction through sport and serving customers with new innovation and hyperlocal products. We saw a strong consumer response to the PEC Premium and the Vomero 18 in running. So that's good. They're catching it head on. They're going for it. I love to see it. Elliot Hill really does feel to me, from what I've heard in the earning calls, like he actually cares about the company. He cares about creating long-term value for the company and in return for its shareholders, which is good. It's good that the CEO has his customers as priority. And after that, looking after its share and stakeholders. And during this Q&A or during this earnings call, there was a Q&A session and somebody asked about this innovation. I'm a little bit disappointed in the answer. It's very cryptic. I do like the one part, we'll get over that in a bit, but it's very cryptic. So he says, we have a dedicated team at our LeBron James Nike Sports Research Lab, and I would like to say that I'm really confident in the team that we have there. And not only the team, but the work that they are doing long-term, creating new innovation for our team. Moreover, he said, it's really coming back to driving newness and refreshness against performance and sportswear, men's, women's, kids, footwear, apparel, and accessories, and not just footwear. Okay, so I like it that he's saying here that he's going to refresh every aspect. That's good. He should tackle every aspect because in the case of Nike, they really do need it. They need new products. They need innovation. They need freshness, like he says, in all parts of the business. And I'm happy he's tackling that on. I'm just not happy about, he says then, and it comes out of our training line, but there's also view to sportswear, and there is some innovation there. So he's very cryptic about what this innovation is. He's not really giving us something to hold on to. He does say like, okay, we're having a turnaround plan. This turnaround plan is going to be focused on every aspect. So performance, sportswear, men's, women's, kids, footwear, apparel, and accessories. Good. But I want to I want to get something more tangible. Like, what are you working on? Bring us the pipeline. But that's just a little side note. I think maybe by the time I'm recording this video, it's already released, or I can find something. I'll look into that later. What I did notice is Elliot Hill. I've listened to the whole earnings call and a couple previous earning calls. He's very long-term driven. He actually, like I just mentioned, he cares about his shareholders. He cares about his customers. He cares about his team. He gives credit to his team where credit is due. He takes responsibility for the mistakes that he has to fix that were either by him or by the other CEO, John Danaho. And he's facing it head on with this whole strategy plan called Win Now. And I admire this a lot. So the next point in this Win Now strategy is strengthening wholesale partnerships. Long time coming. So it says here, after years of pushing a direct consumer to consumers, DTC model, that sidelines traditional retailers, Win Now seeks to rebuild relationships with wholesalers. The shift acknowledges that an over-reliance on Nike's own stores and digital channel reduces market buzz and accessibility, allowing competitors to gain ground. Yes, I do think that competitors were able to take ground, as we saw in the market share right here, because they weren't executing properly. So I'm glad that responsibility is being taken. They're acknowledging that there has to be something, some moves have to be made, and they're doing it, and that's good. I love to see this. And he said it in the most recent earning call. He said, we are also working on elevating the marketplace, and the retail team's done some phenomenal work around elevating our presentation, both wholesale and physical retail. I'm confident that our innovation pipeline is there. Again, he does what a good CEO does. He gives props to the right team. He acknowledges the issue. He says that we have a plan for it, and he's going to tackle it head on. That's good. Like I said, everything I've seen so far from Elliot Hill, it's amazing. The next thing is premium digital experience. So he said, this is the plan. In its DTC channels, particularly digital, Nike is reducing promotional days and discounts to reposition e-commerce as a premium experience. For example, in North America, promotional days dropped from 30 in January to February 2024 to 0 in the same period in 2025 this year. And in the latest earnings calls, it was quoted again. It says, Elliot Hill said, we're already reducing the promotional days and discounting at lower rates. In fact, comparing last year's January and February to this year's, Nike's digital in North America went from over 30 promotional days to 0. Good. Action, they're making promises and they're keeping their promises. They're executing on it. That's perfect. The next part was targeted geographic focus. This strategy zeroes in on 3 countries, the United States, China, and United Kingdom, and 5 cities, New York, Los Angeles, London, Beijing, Shanghai. Good. I love to see this. New York, Beijing, and Shanghai especially. Great markets. They really should be focusing on that. Each location will receive tailored investments in products, marketing, and local teams to address unique market dynamics. So, for example, a proactive cleanup of the marketplace in China to re-engage customers. That's good. They're executing again. I like it. And I noticed something in the most recent earning calls. Elliot Hill said, now that I have had the opportunity to visit each geography, we're clear where we will focus to make an immediate impact. So he actually went to those places, saw what was going on, made a plan, tailored to the location, and he started executing. Perfect. Hands-on, feet on the ground, perfect. What a CEO should do, especially when focusing on this turnaround. It's perfect. He said, through our Win Now strategic priorities, we'll start with 3 key countries, and then he goes on to mention what I just said. Then the last 2 points, revamped marketing approach. So Nike is shifting away from an over-reliance on low-funnel performance marketing. So targeted ads for quick sales, they're going to move away from that. And they're going to go towards what you're used to, the bold, the brand building campaigns, those huge campaigns. They're going to go back to that one. And And they're also going to run ads. What was the one called? Winning Isn't for Everyone, the Olympics campaign. And so win for the Super Bowl in February 2025, featuring Caitlin Clark and Sha'Carri Richardson, aimed at inspiring customers again and elevating the brand perception. Good, wonderful, I love it. And the last thing, operational efficiency. This plan includes cutting costs such as 8% reduction in selling and administrative expenses to 3.9 billion in Q3 2025, achieving partly through workforce reduction and lowering restructuring costs, despite an 8% increase in marketing spend to fuel the turnaround. That's fine by me. If you need to boost 8% of your sales spending to fuel this new turnaround, and it's actually a good plan, and the plan that we have just laid out, it's perfect. Yes, spend as much as you need on marketing, and if you can offset it with reducing costs through workforce reductions and lower restructuring costs, fine by me. All power to you. I think it's a great move. Elliot Hill made a side note. He had described the Win Now strategy, the one we just laid out, as a way to help consumers fall in love with something new by balancing a portfolio across 5 fields of play: running, basketball, football, training, and sportswear. Perfect. I'm loving this plan. This is something Nike needed. I think this is actually the best time that this plan could have been set out for Nike. Losing market share, that's tough. You have consumers shifting away from your products. That's very tough. So you really need to get them to love your product again. You have competition growing, also growing in China. They're executing. That really shows that the issue is within Nike themselves. A lot of operational efficiency issues. Their marketing, it wasn't on point. They're all going after it. It's perfect. The targeted geographic focus, that's perfect. Especially Beijing, Shanghai, and New York. I love it. It's good. It's the right spots. It's the locations they do need to focus on. And I really do think this is a good plan. Of course, we have to see how it works out. But the little steps we're seeing already, that's good. Especially with the DTC and the premium digital experience, all tackling it head on. Also strengthening their wholesale partnerships. Perfect. I'm loving this plan. I think Elliot Hill set out a great plan. I love it that he went foot on the ground to those places to figure out what was going wrong, to really get hands-on with the issue. So that's good. I admire this kind of approach. And I hope to see this work out. So an issue, like I mentioned in the beginning of the video of mine, was also inventory. So this was said in the most recent earning calls. Inventory declined 2% versus the prior year, but as I said last quarter, inventory remains elevated across all geographies. Yes, it is. It remains elevated. I don't like seeing it. It's awful. It's so much value is destroyed in your inventory, and Nike has just an abundance of inventory, and that isn't looking good. I'm happy they acknowledged the issue here again, and I'm happy they're going to tackle it, and I'm really looking forward to the resolution to this. They also noticed while we're seeing some increases in customer cancellations, the large driver of our inventory is in the buys for Nike Direct. Yeah, we've seen that. Again, they're saying we are beginning to see Air Force 1 inventory stabilized with current retail sales, while L Jordan 1 and Dunk remains elevated with continued action plans ahead. Perfect. They're addressing it. Okay, they're not giving as much tangibles to hold on to, but they're addressing it, they're acknowledging it. So I'm believing that they're gonna do something about it, because this right here, it's an ugly picture to look at, especially with the days inventory outstanding being 103.7. You don't want a pair of shoes to sit in your inventory for 103 days before it turns into a sale. So to get rid of this inventory, you have to start discounting it. And that's just going to impact your margins. And so, yeah, the margins, the gross profit margin has been somewhat stable, Operating margins has been very choppy. Also, the net profit margin has been very choppy for Nike, and I do expect more headwinds on the margins because you have the tariffs coming in. You have a turnaround. They have to fund this whole turnaround. It's going to have a significant impact on the margins, and you have the inventory. Yeah, that's not good for the margins to sell at discounts. So that definitely is an issue for Nike there. So can they recover from all this? I want to hope they can. I truly do hope they can recover from this. I think they have a very good turnaround play set out. I feel like listening to the earning calls and listening to Elliott Hall and management, I do feel like there's a shared passion to start creating value for the consumers and for the shareholders again. So I do think if they execute this plan correctly, I do think Nike can start to become the dominant force it used to be again. Will it achieve the growth it had from 2015 to 2020, 2023, or 2019? I don't know. You really need to get consumers to fall in love with your product again. And a consumer who lost his love for your product is really tough to get back in some conditions. Of course, you have the cult-like following. They lost the love, but they see a new product and they come crawling back to you. But your average consumer, I don't know. I'm having trouble believing that they'll come back quickly, even with new innovative and new pipelines of products. So I'm very neutral, leaning towards a bit bearish. I'm definitely going to be sitting on the sidelines and watching Nike as it does its thing. I'm not going to invest in it right now, not at all. There's just too much risk for me, too much uncertainty for me, and I would not like investing in this type of business right now. With that said, let's go over the valuations. So let's do a simple discounted cash flow. 3% perpetual growth rate, a 10% discount rate. In here, there's a risk premium, and the treasury bond yield is processed in here. That's how I use it. Some people implement the beta of the stock as well. I don't do this. Do whatever floats your boat. Filled everything in. I give them a growth rate of 3%. That's very optimistic. They're currently growing their free cash flow with a CAGR of, this is not correct because 2015 is missing, but I think a CAGR of roughly 4%. No, Nike's not going to grow its free cash flow for the next 10 years, 4% year over year. I think 3% is really optimistic already. But I do have some beliefs in their turnaround story. So at that point, we get a fair value per share of $47.36. The current price is $57.47. I really do want a big margin of safety if I would invest in Nike. Putting that at 20%, that would make the buy price, the acceptable buy price for me, it would be $35.38. Yeah. It isn't looking too good for Nike. If you look at a reverse discounted cash flow, so if you look at what the market is pricing into Nike right now, we see their stock-based adjusted free cash flow here with also perpetual or terminal growth rate of 3% and a discount rate of 10% again. The market is currently pricing in roughly 5.87% year-over-year growth for the next 10 years. No. They're not going to do that. They're not going to manage that, especially with all the expenses they have to do and all the cost cutting and other types of expenses for the turnaround and investments. They're going to pick up R&D again. It's tough, especially with the slowing sales. It does not give me the confidence that Nike is going to be able to grow 5.87% per year over year for the next 10 years. Like I said, in my discounted cash flow, what I find more reasonable, and I'm already very optimistic here, is 3%. So for me, Nike right now is not an interesting buy. Sad to see. It's a household name. I love the company. I'm really happy there's new management. Elliot Hill really does seem like a honest and value creating CEO. I just need to see his plan work out and see him execute. If he does execute and Nike is getting this big turnaround, maybe then it becomes interesting again. But for now, I don't find Nike interesting. There's just too much risk for me. Sales are slowing. China, a promising market, they're not executing there. I hope they're going to start executing there again. But for now, I'm going to leave Nike on the sidelines. I'm going to watch it, of course. I love the business. I love to watch it. But I'm not going to invest in it. It's just, it's too expensive right now for my liking. There's too much risks. The turnaround, it's very uncertain. I like to see it completely or executing in full force before I make any rational decisions of holding this stock, because when I buy a stock, I want to hold it for 10 years or 5 to 10 years, at least for the long term. I don't see myself holding Nike right now at a 5-year rate. So that being said, I hope you liked the video. Let me know, do you think that Nike is losing its edge, or is it turnaround bringing the edge back to Nike? If you're a shareholder, please share your thoughts. I'm always open to critique, new information, tips, tricks, you name it. It's my first video ever, so I could use some tips and tricks. And with that being said, I hope you enjoyed the video. Be sure to subscribe, by the way. The videos are free. It's all 100% free. I have a Substack. I write on my Substack about companies, about stocks. So check the link in the description for my Substack and for my Twitter. You can follow me there as well. I post every day, too much sometimes. Like the video, and I hope to see you in the next one. Cheers.